The 2024 federal budget was just released, and one of the items discussed within it pertains to increasing the capital gains tax rate for personally held assets. And I wanted to give you an example of how that could impact you. So let's just say you own a rental property, personally owned rental property. So this is not in your corporation. And let's say you purchase it for $500,000 and it's currently worth $1 million. So the capital gain as of today is $500,000. So the way the tax system works, there's a total capital gain of $500,000. 50% becomes taxable to your income. And let's assume you're at the highest marginal tax rate, which Ontario is 53.53%. Under the old system, the total tax owing would be $133,825. Now, I'm going to exclude things like betterments and improvements for this example. This is just for simple kind of transactional. You purchased the price for $500,000 and sold it for $1 million. Another thing to consider is there's a threshold of $250,000. So if the capital gain is $250,000 or less, it still is called the old system of a 50% inclusion. Anything over and above the $250,000 is now going to be taxed at 66%. So under the new system, the total tax owing and factoring in that additional 66% on everything over and above $250,000, the new tax is going to be $155,237. So there's a difference of $21,412 more in taxes because of these new rules. So under the old system, you have 50% on capital gains, so a total capital gain of $500,000. Multiply that by 50% equals $250,000. You then take that and times it by the marginal tax rate of 53.53%. That equals $133,825. So under the new system, it is 50% on capital gains up to $250,000, and it is 66% over and above that $250,000. So you have a total capital gain of $500,000. You multiply 50% on the first $250,000. That will equal $125,000. You then multiply the other $250,000 by 66%, which equals $165,000. Add 125 and 165 up, and you multiply that by the 53.53%, which gives you your $155,237. So that's the $21,000 differential. Now, that's as of today. So what about if you held this property for the next 20 years? Same scenario, same purchase price, except that $1 million, if you project 5% growth over 20 years, the property would be worth $2.6 million. So 1 million turns to approximately 2.6 million. Again, excluding betterments and improvements, you now have a capital gain of 2.1 million. 50% becomes taxable to your income. Under the old system, the total tax owing would be $562,065. However, under the new system, the tax owing would be $720,514. So this is a difference of $158,449 in more taxes because of this increased rate. And just to break down the math, so the old system, you're going to have 50% on capital gains. So you take the total cap gain of 2.1 million, multiplied by 50%, and then multiply that by the tax rate of 53.53%, gives you your 562. The new system, again, it's 50% on capital gains up to 250, and then 66% above that. So you take total cap gain of 2.1 million, you multiply 50% on the first 250, which equals 125, but then you multiply the additional 1.85 million by 66%, which will give you 1.221 million. Add up the 125 and the 1.221, gives you 1.346 million. Multiply that by 53.53%, gives you the 725.14, and that's the differential. Moving forward, one more stage, because I mean, depending on your age and how long you plan on holding this property for, it's not unlikely to hold this property for 20, 30, or even longer. So again, same scenario in 30 years at 5% projected growth over 30 years, that $1 million actually turns to 4.3 million. Total cap gain of 3.8 million, excluding betterments and improvements. So now what's taxable to your income would be 1.9 million with the old system. So the total tax owing is just over $1 million at $1,017,070, except with the new system, it's 1.321 and $120. So there's a big difference now. You're at over $300,000 more in taxes with the new system. And again, the math on that old system, you have 50% on cap gains, total cap gain of 3.8 million, multiplied by 50%, and then multiply that by 53.53%. That'll give you your just over $1 million. New system, 50% on up to 250, 66% above it, total cap gain of 3.8 million. So you multiply 50% on the first 250, it'll give you 125, and then you multiply 66% by the additional 3.55 mil. add up the 125 and the 2.3 million. That'll give you 2.468. Multiply that by 53.53%, and that'll give you your 1.321120 new tax rate. So this can certainly have an impact on personally held assets. This can, it doesn't have to just be with properties. It can be with stock portfolios or other assets. So this is just an example. It could be your family cottage, but either the more value you have in these assets or the more assets you have, there can certainly be a large impact to how much you're potentially going to owe with capital gains taxes with this new proposal. So I wanted to give you one solution to help pay for these taxes, because there's strategies to help minimize the tax rate, but it can't always be completely eliminated. So there is going to come a day where you have to decide how are you going to pay or come up with the money to pay for this tax bill, because it may be inevitable. So I call this the $1 million tax bill question. And I say, let's just say we did the math, and after all the strategy in the world and your accountants and your lawyers and myself, we put our brains together and we've minimized the tax as much as we can, but there's still $1 million going to be owed. What are your options to pay this $1 million? Like, how are you going to come up with the money? The first option is you could just self-insure. And self-insure means you retain the risk. You are going to pay this $1 million with your own assets. And I like to show the variety of assets you can consider paying, because there are some terrible ways to try and address the $1 million tax bill owed in your estate, and there are certainly more favorable ways. So if someone wanted to use their RSP or RIF to pay this $1 million tax bill, they would have to have over $2 million in their RSP or RIF, die with that, lose $1 million approximately in income taxes when they die to net that $1 million. So this is a very, very expensive way to do so. I would never recommend this, but a lot of people don't realize how taxable their registered accounts are when they pass away. And keep in mind, this tax bill is only owed in this scenario when they go to pass this property down to their children. Second option, maybe you have additional property. So you certainly could sell it to try and come up with the money. Now you have to certainly consider capital gains taxes on that property, timing of the market, commissions, legal fees, etc. So is it an option? Yes. Is it the best option? I'm not sure about that. And you could also use cash. So if someone had $1 million in cash, there's no capital gains taxes on cash when you die. So you could tell your executor, take the $1 million, pay off the tax bill, and technically that's true. But I would argue using cash to solve a tax bill in your estate it's a complete waste of your own money. It's a very expensive way of solving that problem. There is a fourth, much more efficient way to come up with $1 million. So for now, we'll call this capital gains insurance. And this is an example of $1 million whole life insurance policy on a 50-year-old couple and its joint last to die, which means the $1 million is paid out after the second spouse passes away. So if you have a spouse, you can roll over your assets to them on a tax-free basis. So the tax bill isn't triggered until either both spouses pass away, or if there is no secondary spouse and you pass away and you go to give the assets down to your children. That is really when the tax bill occurs. So if there's a couple, husband dies first, all the assets go to the wife. But if both parents pass, or when they both pass, the kids can't just inherit everything tax-free. It's as if you sold everything you ever owned, called a deemed disposition, and that's where these tax bills can come into play. So this option is going to be at least 50% cheaper than cash, which already is going to save you a significant amount of money. So they could invest approximately $21,000 a year for premiums in exchange to have a $1 million life insurance policy paid out from day one. So if they died tomorrow, $1 million gets paid out. What they could do is they could invest this $21,000 into this whole life policy for approximately 12 years. And if you do the math on that, they've invested just over $250,000 in premiums. So if you stop right there, what they've done is they've exchanged $250,000 to get $1 million paid to their beneficiaries or estate when they die. So they have just saved about $750,000 because they've put up $250,000 to get $1 million paid to solve this tax bill issue. So buying insurance is really buying a future amount of money you're going to need at a significant discount today. And the reason they stop in 12 years, this is just an illustration, but the policy is put on something called offset, which means for future years, the policy is paying for its own premiums. And there's some more details to get into, but this is just an example. The difference with this, though, is it's not just money out the door. It's not just like car insurance, house insurance, where you can never ask for your money back. You're just sending money out of your bank account. what they've done in this scenario is they have the cash value, which this couple can and should use during their lifetime. So to give you an idea of what the cash value might be in that 12th year, it's an approximation, but it could be anywhere around $328,000. So what that means is they've put up $252. They've have growth on that, upwards of over $300,000 that they can use on a tax-free basis during their lifetime. They don't have to wait for the 12 years to use it. This is just showing you the year they're potentially done paying versus, and as well as what the cash value could be in that year. If they waited, say, 20 years to touch the cash value, it could be, easily over $400,000. So doing the math on this, they've just saved 74% on that $1 million tax bill by using a insurance policy to solve that problem. So they're not self-insuring anymore. They're actually completely passing off the risk to the insurance company. They are paying premiums, but they're going to use whatever they've put into the policy plus growth during their lifetime on a very tax-efficient basis, and the issue of the $1 million tax bill is still going to be solved. So to look at this in a bit of a different light, you have your $1 million tax bill. It could cost you twice as much using RSP or RIF. It'll cost you dollar for dollar if you use cash, or you put in the amount into insurance premiums. You have more in the cash value. That's continuing to grow year over year. Plus, you end up with the $1 million of life insurance, and that's actually continuing to grow as well. I think most importantly, it's this blue column. It's the savings. Even if you had $1 million in cash, I would just say take a quarter of that, put it aside, slowly drip that into an insurance policy, and go spend the other $748,000 during your lifetime. You don't have to keep $1 million aside to pay this $1 million tax bill. So there are very effective strategies to solve tax issues, and whether you have personally held assets or corporately held assets, speaking with the right team of professionals and individuals can certainly help you minimize and really create a much more efficient financial plan for yourself.